Welcome back to Talk Tickers. This is the show for the buy side, by the buy side, where we strip down earnings calls to the raw numbers and the real story.
No fluff.
No fluff here. We do the P&L reality, not the PR spin. I'm your host, and today we're looking at a ticker that has been on a wild ride, to say the least. We are talking about TripAdvisor, ticker symbol TRIP.
It's good to be here. Although looking at the screens this morning, wild ride feels like a very polite euphemism for a car crash.
Yeah.
I mean, if you're long this name, today is painful, deeply painful.
Painful is the word. Let's set the scene immediately for everyone. It is Friday, February 13th, 2026.
Kooky.
I'm not usually superstitious, but, the market has certainly handed down a horror show of a verdict on the Q4 2025 print that dropped this morning.
The date is fitting. It really is. The tape doesn't lie.
The tape does not lie. Let's look at the price action right now. The stock is currently trading around, $10.15?
Just hovering above that $10 mark.
Yeah, and we are seeing a shed of about $2.01 per share. That is roughly a 16.5% decline from yesterday's close of $12.16.
And that $10 level is so psychological, right?
It's huge.
You break 10, and in the minds of a lot of institutional allocators, you start to enter penny stock territory.
Yeah.
It changes the entire perception of the company.
It really does.
And the volume. The volume is telling the real story here.
Oh, yeah.
We're seeing about, 11.6 million shares traded already? Keep in mind, a standard day for Trip might be 5, maybe 5.2 million shares.
So we're more than double the volume before lunch. This is capitulation.
It is. It feels like a liquidation event for some funds.
Mm-hmm.
I mean, someone is getting a margin call this morning. Investors are just running for the exits.
They're hitting the sell button and not looking back. But why? That's the question we need to answer over the next hour. Because on paper, management is selling a very sophisticated story. A story of fundamental business transformation.
Oh, it's a great story.
A great story. They are shifting from a legacy advertising model, the old TripAdvisor we all know, to a high-growth marketplace with Viator. But the market isn't buying the story today.
No, not at all. The market is looking at the bill for that story. It's the classic good narrative, bad print dilemma. Management says, look at our amazing future. And the market says, I'm looking at your GAAP net loss right now. I'm looking at your margin compression.
Exactly. The future is great, but today is terrible. So here's our roadmap for this deep dive. We're going to unpack that headline miss, why revenue was flat and why the EPS just collapsed.
Yeah, we have to start there.
Then we're going to dissect the segment split, which is really a tale of two very different companies. The melting ice cube, that is hotels, versus the growth engine, Viator and Experiences.
And we have to go deep on the profitability problem. That's the core of it. Margins compress significantly in Q4. We need to explain why that operating leverage that they keep promising isn't showing up yet.
Then we'll get into the strategic review, specifically the potential sale of TheFork. That is the hidden ace in the hole here, I think.
It's the catalyst, the one bright spot.
And finally, we have to touch on that 2026 guidance, because the Q1 outlook, it frankly spooked the street. It was ugly.
It really was.
And as always, stick around for the end where we do our not financial advice segment. We've got a sum of the parts breakup trade idea that might just be crazy enough to work.
It's a fun one. But first things first.
First things first. Let's start with the cold, hard numbers, the results snapshot. Walk us through the carnage.
All right, let's just rip the Band-Aid off. Let's start at the top of the funnel. Revenue. It came in at $411 million.
Okay. 411.
That was effectively flat year over year. 0% growth. Give or take a rounding error.
So in a world where inflation is still running, 3% and travel demand is supposedly robust, flat is effectively down.
Precisely. In real terms, the business shrank. And it was a miss against consensus, which was looking for roughly $412.7 million.
So a small miss on the top line.
Yeah, a $1.7 million miss on the top line isn't usually enough to tank a stock 16%. It's an annoyance, not a disaster. The real issue, the real pain point, was the bottom line.
The flow through, there was a none.
Worse than non-existent.
Yes.
Was negative. Let's look at non-GAAP EPS. Reported at just 4 cents.
4 cents.
The street was looking for 13 cents.
Wow.
That is a massive miss. They missed the number by nearly 70%.
That's a huge variance. Usually you see a penny beat or a penny miss. Missing by 9 cents on a 13-cent estimate implies a fundamental disconnect between what the analysts modeled and what the business actually costs to run.
It's not a rounding error. It means a core assumption in the models was just wrong. And if you look at GAAP, it's even uglier.
Yeah, let's look at the real number.
A net loss of $38 million. That's a negative 33 cents per share. And keep in mind, they swung from a profit in the prior year to a pretty significant loss.
That's a bad direction. So revenue flat, but costs exploded somewhere.
Exactly. So let's talk about EBITDA. Because for these transitional tech stories, adjusted EBITDA is usually the metric that forgives a lot of sins.
It's the number management wants you to look at.
Right. It smooths everything over. But did it hold up here?
I'm guessing no.
No. Q4 adjusted EBITDA came in at $45 million.
Okay.
That represents an 11% margin. Now, to give you context, for the full year 2025, they ran at a 17% margin.
So a 600 basis point compression in a single quarter?
In Q4, yes. Yeah. It came in at the very low end of what management even guided to. They just barely scraped by their own low bar.
So we have flat revenue, a massive earnings miss, and shrinking margins. It is no wonder the sentiment is risk-off today.
No wonder at all. It feels like investors are looking at the legacy cash cow, the hotel business, and seeing it deteriorate much, much faster than the new growth engine can profitably replace it.
That's the core thesis breaker, isn't it? The timing.
That is it. The bearish put activity we saw in the options market leading up to this print, they were right.
They nailed it.
They nailed it. The market is saying, we don't trust the timeline of this pivot. We know the destination. They want to be a marketplace model. But the bridge to get there looks incredibly rickety right now.
All right, so let's unpack that bridge. To understand TripAdvisor in 2026, you have to understand that it is two completely different businesses glued together. It's a Frankenstein's monster of a company right now.
It really is.
You have the legacy side hotels, media, and platform, and you have the growth side experiences and Viator. Let's start with the anchor dragging the whole ship down, the legacy business.
This is the melting ice cube. And honestly, the ice is melting faster than I think even the bears anticipated.
The numbers were bad.
They were shocking. Revenue in the hotels, media, and platform segment declined 15% year over year in Q4 to $151 million.
15%. Okay, but dig into the media and advertising line specifically. Yeah. That's the old school, high margin, pure profit business.
That dropped 17%.
17.
That is a hemorrhage. A 17% decline in your highest margin business is a 5-alarm fire.
Okay, we need to stop here and explain why. Because this isn't a cyclical travel downturn. People are still traveling. Travel demand isn't down 17%. People are still going to Paris. They're still going to Cancun. So why is TripAdvisor losing 17% of its advertising revenue?
Because this is a structural issue, not a cyclical one. It's about the fundamental mechanics of the internet. For 20 years, TripAdvisor relied on what they call flyby traffic.
All right.
You go to Google, you type best hotels in Rome, and for years, the first organic link was TripAdvisor. You click it, you see an ad for Expedia or Booking, TripAdvisor gets paid. Simple.
The famous 10 blue links. That was their entire business model for a decade.
Exactly. Well, those days are over. The driver here is the structural headwind in SEO search engine optimization, and more importantly, the rise of AI overviews in search results. Google is keeping that traffic for itself.
Right. I've seen this. Now, when you type best hotels in Rome, Google's AI, Gemini, just gives you a summary right at the top of the page. It lists the hotels right there. It gives you pictures, prices. You don't need to click through to TripAdvisor to get the list anymore.
Correct. The top of the funnel is being severed. Google is answering the query directly, and TripAdvisor is getting disintermediated. So that free high-margin traffic that powered their P&L for a decade, it's just disappearing.
And it's never coming back.
It is never coming back.
Yeah.
Management was pretty candid about this on the call. They basically admitted they aren't even trying to chase that low-margin revenue anymore.
That's a pivotal admission. They are conceding the SEO war to Google.
They have to. You can't fight the platform owner. It's a losing battle. So the strategy for the hotels segment has completely shifted from growth to cash management.
Manage for decline.
Exactly. They are cutting costs. They mentioned personnel costs are down in this segment. And they are managing it purely for profitability and cash flow. They explicitly called it a funding mechanism for the rest of the business.
It's a very polite way of saying cash cow. They are milking the cow while it's sick to pay for the new calf.
That's the plan.
But here's the problem with that strategy. If the cow dies too fast, the calf starves. And a 17% decline is a very, very sick cow.
That is the risk. That is the entire bear case in one sentence. The decline is accelerating. A 17% top-line drop is incredibly hard to cost-cut your way out of. You have to slash headcount so aggressively to maintain margins when your revenue is falling that fast. And eventually you cut into the bone and the whole thing collapses.
All right, so let's talk about the CAF, the growth engine, Experiences and Viator. This is the entire bull case for the stock. If you are buying TreeIP at $10 today, you are not buying it for the hotel ads. You are buying it for Viator.
Correct. And if you isolate this part of the business, the story looks much, much better. It's like looking at a different company.
Okay, give us the numbers.
Q4 revenue for Experiences grew 10% to $204 million.
Okay, 10% growth. Solid.
But the more important number is gross booking value GBV. That grew 16% to nearly $980 million.
So almost $1 billion in bookings in just one quarter. That is real scale.
It is. This is not a startup anymore. This is a market-leading platform. And the momentum is real. They exited 2025 with Q4 bookings up 18%.
So growth is actually accelerating slightly into the new year.
It is, and that's the conflict, right? You have one side of the business shrinking at 15 to 17%.
And the other side growing at 16 to 18%. And the mix shift is happening incredibly fast. The marketplace businesses, which includes Experiences plus the dining segment, TheFork now make up 61% of group revenue.
Think about that stat for a second. 61%. Back in 2022, that was roughly 40%.
Wow.
In just 3 years, they have flipped the entire company upside down. It used to be an ad tech company that sold some tours on the side. Now it's a tour marketplace company that sells some ads.
That is a massive transformation of the company's DNA. It changes everything about how you have to value the stock. Ad tech trades at one multiple. Marketplaces trade at a totally different, usually higher multiple.
The goal, according to the CEO, Matt Goldberg, is that by the end of 2026, so by the end of this year, Marketplace will be 2/3 of total revenue and half of the company's EBITDA.
Okay, that sounds great on a slide deck. But we have to address the profitability disconnect. This is the elephant in the room. Because if Viator is growing 16% and it's becoming the majority of the company, why did consolidated EBITDA margins crash to 11%? Why isn't this growth profitable yet?
Because growth in a marketplace is expensive. It is very expensive. You have to buy the demand.
Performance marketing.
Performance marketing, exactly. In the old hotel model, the traffic was basically free from SEO. In the new Viator model, you have to go out and pay Google for ads to get people to click and buy tickets.
So what did that do to the margins in that segment?
Margins in the Experiences segment specifically fell to just 7% adjusted EBITDA.
7%.
7%. And that is down significantly from the prior year.
7% is razor thin. I mean, some grocery stores have better margins than that.
It's the Amazon strategy, right? You run at or near break even to capture market share, build the moat, and then theoretically you raise prices or find efficiencies later.
The jam tomorrow promise.
Exactly. Management said the cause was a deliberate increase in marketing spend to capture that demand. They saw an opportunity and they spent into it. They also mentioned they were lapping a one-time tax benefit from the previous year, which makes the year-over-year comparison look a bit worse than it actually is.
Okay, but is it just a comparison issue? Or is there something structural here? Because as an investor, you see 16% GBV growth, which is great, but then you look at the bottom line and say, where is the leverage? Where is my profit?
That is the multi-million-dollar question. Management claims, and they were very insistent on this, that these marketing investments are immediately profitable on a transaction basis.
Meaning the ROAS, the return on ad spend, is positive.
Right. They argue the unit economics are positive. They say, we spend $1 on a Google ad, we make $1.10 back immediately on that specific booking.
So the variable costs are covered.
Yes. But the overhead, the fixed costs, the tech platform, the engineers in Needham, the HQ costs, all of that is eating the quarterly print alive. You need massive, massive scale to cover that fixed cost base with only a 7% contribution margin.
So it's that promise again. Let us spend the money now, let us acquire the customers, and we promise the margins will expand later. But in this market environment, with interest rates where they are, investors want cash flow today. They don't want to fund a marketing experiment for 2 years.
Especially when the funding mechanism, the hotel's business, is drying up so quickly. The clock is ticking. And there's a nuance here regarding marketing efficiency that we need to geek out on for a second because it's important.
Please do.
Management claims marketing as a percentage of GBV is flat.
Okay, so what does that mean?
That's good. It means they aren't getting less efficient at acquiring customers. It costs them the same amount in Google ads to sell a $100 ticket today as it did last year.
Okay, that's a positive signal. It means competition isn't driving up bid prices on keywords too badly. They're holding their own on efficiency.
Correct.
Yeah.
But, and this is the crucial part, because the hotel revenue, which used to be almost pure margin, is dropping so fast, marketing as a percentage of total group revenue deleveraged. It increased.
I see. The denominator in the equation is shrinking faster than the numerator.
Exactly. The legacy business, the high margin part, is shrinking faster than the new business can optimize its costs. That is why the consolidated margin for the entire company dropped to 11%. It's a math problem. The high margin revenue is vanishing and is being replaced by lower margin revenue. Even if that new revenue is growing fast, the blended margin has to go down in the short term.
That is the melting ice cube problem in a nutshell. The ice is melting faster than you can freeze the new water. Now let's shift gears to a piece of news that actually offers a potential lifeline. This is the one bright spot that kept the stock from maybe going to $8 today. TheFork.
The dining segment.
Performance here was actually strong. Q4 revenue was up 18%. B2B subscription revenue for restaurants was growing over 20%.
It's a very good business. And for our listeners who are primarily US-based, you might not appreciate just how dominant TheFork is in its core markets.
Explain that.
It is the leading restaurant booking platform in Europe. Think of it as OpenTable, but arguably with even better market dominance in countries like France, Italy, and Spain.
It's a household name in Europe, a really strong brand. And the news. Management announced a formal exploration of strategic alternatives for TheFork.
Which is, as we all know, corporate speak for, we are hanging a for sale sign on the front door.
So they're looking to sell it. Why sell it now? If it's growing 18% and it's profitable, usually you sell the losers, not the winners.
It comes down to two things, focus and capital. Management's rationale is that while it's a great business, it has limited synergies with the core travel and experiences focus of Viator and the main TripAdvisor site.
Is that really true, though? I mean, when I travel, I eat. Seems like a pretty obvious synergy.
You do. But the customer behavior and the booking window are very different. You book your flight in your hotel maybe 3 months out. You book your museum tour 2 weeks out. You book your dinner reservation 3 hours out. The cross-sell opportunity, getting someone who just booked a hotel to immediately book a specific restaurant for a dinner 3 months from now, has always been much harder than it looks on paper.
That's a fair point. So they're admitting the synergy they thought was there really isn't.
And more importantly, a sale could bring in a massive cash infusion. We'll talk about the potential valuation of that in our trade idea later, but the implication is clear. They sell this, they get a huge pile of cash. What can they do with it? They can buy back stock, which is now incredibly depressed, or they can pay down debt. It also removes a distraction from the portfolio.
And it simplifies the story for investors. We hate conglomerates. We hate sum of the parts discounts.
Exactly. Right now, if you're a PM, you have to ask, am I buying a hotel search engine, a tour booking site, a restaurant reservation system? It's too messy. Getting rid of TheFork makes TripAdvisor a pure play on experiences with a legacy funding arm. It's cleaner. Wall Street understands clean stories, and it pays for them.
Cleaner is better, no question. Let's touch on the tech side for a minute. Everyone is talking AI. It's 2026. If you aren't talking AI on your earnings call, you aren't a tech company.
It's table stakes.
Right. So TripAdvisor is pivoting from something called Trip Planet to a new AI native MVP that they launched in Q4. Is this just buzzword bingo, or is there a real product here?
There is a product,
Yeah.
and the strategy is actually quite clever, I think. They're trying to solve what they call the trust gap in AI travel planning.
Okay, define that for me.
All right, so management's thesis, based on their data, is that about 50% of people now use AI to plan trips.
We've all done it. You go to ChatGPT or Gemini and say, give me a 3-day itinerary for Tokyo, and it spits out a pretty good list. It's fun.
It's a great starting point, but fewer than 10% of people actually book anything based on that AI output. So why the gap?
Because AI hallucinates. It makes things up. It tells you to visit a museum that closed 3 years ago. Or it suggests a restaurant that has terrible reviews and is a complete tourist trap.
Exactly. You don't trust it. Or it gives you a generic list, but no link to actually buy the tickets. You still have to go back to Google or a dedicated site to verify the information and then make the booking. There's friction.
So TripAdvisor wants to be the trust layer.
That's the phrase they used. They have this massive moat of user-generated content, 80 million new reviews and contributions from 2025 alone. They have the real-time availability data from their suppliers. They want to bridge that gap between planning and booking.
So the idea is you ask the AI for the plan, and TripAdvisor injects the verified data, the recent reviews, and the Book Now button right into the chat.
Right. And they have partnerships live now. The Viator plugin is live in ChatGPT, so is the main TripAdvisor one and TheFork.
So when you ask ChatGPT for a tour of the Colosseum, it can pull real bookable inventory from Viator.
Yes, and that's very strategic. They are positioning themselves not just as a destination website that you have to go to, but as the data infrastructure for the large language models.
The Intel Inside strategy for travel.
Exactly. Be the engine behind the AI. If they can pull that off, it's a huge, huge moat. Because Google might have the search engine, but they don't necessarily have the deep, verified, real-time inventory for every tour and activity in every city in the same way Viator does. That's a unique data asset.
That is a unique asset. But again, it's early days. It's not moving the needle on revenue today.
Not yet. It's a call option on the future. And right now, the market isn't paying for call options.
The market wants cash.
Which brings us to the part of the call that is moving the needle in the wrong direction. The 2026 guidance. This is the part that really scared the street and caused that huge gap down at the open this morning.
It was the Q1 warning. It was brutal. They guided for Q1 2026 revenue to be down 3 to 5%. Down. After telling us this whole story about growth and transformation in marketplaces, they are guiding for a decline in the immediate quarter. Why? That just seems to contradict the whole narrative.
Seasonality is a cruel mistress here.
Oh.
You have to understand the shape of the revenue curve for their two businesses.
Okay.
The growth engine Viator and Experiences is very summer heavy. People book tours and activities for their summer vacations, so Q3 is their Super Bowl. Q1, January, February, March is the quietest time of the year for them.
Okay, so the growth engine is idling in the winter. Makes sense.
Right. However, the shrinking engine, the hotels business, is a year-round business, but it's declining every single day. So in Q1, the structural decline of the hotels business mathematically outweighs the seasonally slow growth of the experiences business.
It's a timing mismatch. The bad stuff is happening now. The good stuff hopefully happens in the summer.
Precisely. But that mismatch creates a very dangerous optical trend for Q1. And the margins they guided to in Q1 are expected to be razor thin. They guided to just 3 to 5% adjusted EBITDA margins.
3 to 5%. That is perilously close to break even. I mean, that's zero.
It leaves absolutely zero room for error. If the economy hiccups, if travel demand softens even a little bit, if there's a geopolitical event, they could easily swing to a loss in Q1. That risk premium is being priced into the stock today. Investors hate uncertainty, and a 3% margin is basically uncertainty with a decimal point.
But the full year guidance was better, right? They aren't predicting a disaster for the whole year.
No, for the full year, they are sticking to the framework. Modest consolidated revenue growth for FY 2026. And for experiences specifically, they are promising low teens revenue growth with 300 to 400 basis points of margin expansion.
Okay, that is the promise investors are waiting for. 300, 400 BPs and margin expansion in the growth business. If they deliver that, the stock at $10 is a steal.
If.
But if is doing a lot of heavy lifting in that sentence right now.
It is. And on the other side, hotels is expected to decline mid to high teens for the full year. That anchor isn't getting lighter. It's getting heavier.
Let's zoom out then and look at the investor context here. We mentioned the stock is down 43% over the last year. That is a disaster compared to the sector. The consumer discretionary ETF, XLY, is actually up slightly over the same period.
TripAdvisor has massively, massively underperformed. And it's because of this structural identity crisis. Is it a dying ad tech company, or is it a burgeoning marketplace? The market punishes complexity and uncertainty.
The structural thesis is clear, though, if you're willing to look through the noise. This is no longer a hotel search company. It is an experiences marketplace that happens to have a dying hotel appendage.
That's the bull case. That's what you're buying. You are buying the market leader in experiences. Viator is approaching $5 billion in gross booking value for a deeply compressed multiple. And you're betting that eventually the hotel business becomes so small that it stops hurting the overall growth rate.
It's the crossover point.
Exactly. It's purely a math game. Once hotels is only, say, 20% of revenue instead of 40, a 15% decline there matters much, much less to the consolidated number. The bulls are betting we are very near that crossover point where Viator's growth mathematically overwhelms the hotel decline.
And the bear case. What's the counter argument?
The bear case is that the hotel business, the melting ice cube, generates all the free cash flow that funds the company. If that cash cow dies before the experiences business becomes fully sustainably profitable, and remember, experiences margins are only 7% right now, then the company runs out of fuel.
And they have to do something dilutive.
They might have to raise debt at unfavorable rates, or worse, to lose shareholders at these low prices just to keep the lights on and fund the marketing budget. That's the nightmare scenario.
Which brings us to capital allocation. They have been buying back stock, which is a sign of confidence.
They have. They repurchased 3.3 million shares in Q4 for $50 million. And they've reduced the total share count by 21% since 2024. That is aggressive. It shows that management and the board believe the stock is cheap.
But they also have a big chunk of convertible notes due in April, right?
They do. They have about $1 billion in cash on the balance sheet, which is good.
Yeah.
But they do need to refinance those notes. They mentioned a plan for a term loan. It seems manageable, but it's another moving part in an already complex machine. You don't want to be going to lenders to refinance debt when your stock is tanking and your margins are compressing. Lenders smell blood in the water.
It's not a position of strength. Okay, we've laid out the battlefield, the carnage of Q4, the promise of the pivot, the pending sale of TheFork. Now let's get to the part everyone waits for, the not financial advice segment.
Let me get my disclaimer voice on. This is for entertainment and educational purposes only. Do your own diligence. We are just two voices on a podcast. We might be wrong. We often are.
Exactly. Don't sue us. But if I were sitting on an investment committee right now, looking at Trippy at $10.15, here's the pitch I would make. I'm calling this trade the Michelin star breakup. Or, if you want to be more technical, the sum of the parts arbitrage.
I'm listening. Walk me through the setup.
The market is pricing TripAdvisor as a single declining legacy asset. It sees the hotel declines and it panic sells the entire company. It is completely ignoring the granular value of the subsegments. So the setup begins with TheFork.
Okay, the asset they're selling.
The asset they've put up for sale. TheFork is growing 20+% and we know it's profitable. Now, what is a dominant European dining marketplace worth in the open market?
Well, let's look at some comps. The big one is Booking Holdings buying OpenTable years ago. I think that was for $2.6 billion. Now, that was a long time ago, different market. But OpenTable was the dominant player in the U.S.
And TheFork is the OpenTable of Europe.
It is. And if you look at more recent comps, you could look at players like DoorDash or Uber Eats. They trade at decent revenue multiples, even if they aren't all profitable.
Right. So TheFork is probably doing, what, somewhere in the neighborhood of $200 million in annual revenue. That's a conservative estimate based on their disclosures. What kind of multiple would a strategic buyer put on that?
For a high-growth, profitable marketplace with a strong brand and a competitive moat, I mean, you could easily argue for 3 or 4 times revenue, maybe more.
So let's take the midpoint. Let's be reasonable. Let's say 3.5x revenue. That puts the valuation of TheFork alone at around $700 to $800 million.
That seems very reasonable, and I think that could even be conservative if a bidding war starts between someone like a DoorDash and a Booking, who both want that European footprint.
Okay, so let's say they sell it for $800 million. They have to pay some tax, some deal fees to the bankers. Let's say they net, what, $650 or $700 million in cash to the balance sheet.
Okay, I'm with you. $700 million in cash comes in the door.
The current market cap of TripAdvisor, with the stock at $10.15, is roughly $1.4 billion.
Wait a second. So you're saying TheFork alone is worth half the market cap of the entire company?
Potentially more. Plus, don't forget, they already have about $1 billion in cash on the balance sheet right now.
Okay, so let's do the math on the enterprise value.
Yeah.
You take the $1.4 billion market cap.
Yeah.
You subtract the $1 billion in cash. That means the enterprise value today is only $400 million.
Around that, yeah. And if you then sell TheFork for a net $700 million in cash, you are generating more cash than the enterprise value of the entire company.
So you are effectively getting the rest of the business, the TripAdvisor website, and Viator for free.
You are getting Viator for free.
Viator, which did almost $5 billion in bookings last year.
Exactly. That's the trade. You buy the stock at $10. You are betting specifically on the catalyst of TheFork sale happening in Q2 or Q3. The cash hits the balance sheet. The enterprise value goes negative. You own the largest tours and activities marketplace in the world for essentially a negative price.
That is the arbitrage. You are buying the whole bundle for less than the price of the spare parts, and you're getting the engine Viator for nothing.
It's a classic sum of the parts dislocation. The market is so focused on the narrative of the hotel decline that it has completely mispriced the underlying asset value.
So what's the risk? What blows up this trade?
The risk is timing. The risk is that they can't find a buyer for TheFork, or they're forced to sell it for a fire sale price because everyone knows they're a motivated seller.
Or the risk is that the hotel business collapses to zero so fast that it burns through all that cash before the sale even happens.
That too. Or a recession hits Europe and the dining revenue at TheFork collapses, making it less attractive to a buyer. There are real risks.
Sure, so how do you hedge that to protect yourself from just a general travel downturn?
The variant on this trade, the more sophisticated version, is you pair the long trip position with a short on a pure play hotel metasearch competitor. You could short Trivago or just a generic travel ETF.
So you hedge out the macro travel risk.
Exactly. You isolate the value of the corporate action. You're betting on the breakup value, not the travel economy. Long the breakup, market neutral on travel.
That is a sharp, albeit very risky setup. It requires patience and a real belief that management can execute a complex M&A transaction while their main business is on fire.
High risk, high reward. That's why we watch the ticker.
So to recap today, Q4 was messy. A big EPS miss, a GAAP loss, serious margin compression. The market hates it, and justifiably so.
But the strategy is clear. Pivot to experiences, sell TheFork, and manage the hotel's business for cash. The market reaction of down 16.5% says, show me the execution, stop telling me the framework.
That's the bottom line. The company exiting 2026 will be a completely different animal than the one that entered it. It's a company in transition.
The question for you, the listener, is this. Do you have the stomach to hold through the construction phase of this renovation? It's going to be dusty, it's going to be loud, and it might look ugly for another quarter or two. But the blueprint for what they're building looks interesting.
It certainly does. Just maybe don't look at the stock price every single day.
That's some good advice. That's it for this deep dive into TripAdvisor. Talk Ticker is signing off. Do your own diligence, and we will see you next quarter.
See you then.